Evening, everybody. Uneducated Economist here. So I was reading this article coming out of Bloomberg talking about Danish debt, and apparently over in Denmark, the 10-year bond that they issue, their sovereign bond, is paying out at a 1/2 yield, right? 0.5% yield. And the mortgage bonds, now we have mortgage-backed securities here in the United States where they take a bunch of different mortgages, they bundle them up into a box and sell it as a security. Investors get to buy that, and as the mortgages get paid off, the investor gets paid back. I'm not sure exactly how the mortgage bonds work over in Denmark, but apparently they have something called mortgage bonds. And these mortgage bonds are more liquid than the sovereign debt, than the 10-year bond that's, that the government issues. So there's such a demand for these mortgage bonds coming out of Denmark that the yield has gone negative, that the mortgages that are being issued are in such a demand, not necessarily for the mortgages themselves, which I'm sure a lot of people are wanting the mortgages, but the debt instrument itself that is created from the mortgages, that is in demand. That's where the mortgage bonds come in. And there is such a demand for them that a bank is able to actually loan money to somebody for their house, for their mortgages, at a negative yield in order to create that instrument of debt and sell it for a profit. Okay? I cannot see how this could possibly continue on. I don't see how this could work on an extreme. Okay? I can see where, because it's barely, we're talking just barely under 1%, right? I mean, it's like barely broken zero. But it's still, it's a bank saying, here, I'm going to write a check to the seller of that house, and I'm going to ask you to pay me back less than what I write that check for. And the reason why I'm doing it is because when you sign that dotted line, that instrument of debt that you just created, I can sell that thing for a profit. Because there is such a demand for fixed income, even if it's negative. So I can't imagine this working on an extreme. Like I said, if you can imagine buying a house for $400,000, going to a bank and the bank saying, okay, here, sign on the dotted line. You get here, they write a check to the seller. There's your $400,000 for the house. Now you, as the borrower, pay us back $380,000 over the course of the next 30 years. The bank is going to be totally cool with this because they're going to take that instrument of debt that you just signed that says, I promise to pay back $380,000, and they're going to be able to sell that for a profit. Does that sound like it is a concept that can last indefinitely? Because that is what is going to happen if it continues, right? That's the trend that would take place, and that's what you would be seeing if it continues into that path. See, right now there is such a demand for this fixed income coming from pension funds, coming from, people, retirements in general, people who are like insurance companies. There used to be a time where people would buy bonds simply for their retirement. They would invest in nothing but bonds and roll them over into new bonds, and towards the end of their life, they would start allowing the bonds to cash in, or they would live on the interest payments, or, whatever. But now bonds don't work like that. See, bonds pay such a low interest rate that nobody really cares about what the interest rates are. All they care about is where they're going, because they can buy these bonds, and even if they go negative, if interest rates drop, they'll be able to sell them for a profit. Okay? It is pure speculation. That is the only way this works. And now you think about, as these fixed incomes, as these insurance companies, as, the pension plans are seeking out interest rates, they're seeking out the most that they can get, and they're going into junk bonds. They're going into high yielding corporate debt. Now, this is typically something that they would not get into because of the risk management that goes in with it. You got to be able to think, okay, is this company going to be so viable that I'm willing to loan them money instead of a corporation that is a sound company, because their interest rates that they pay on their bonds are so low that you have to go to these riskier people. All right? And this sucks down into this vortex as the interest rates get cheaper. As you go to these riskier debts and you grab those higher yields, it brings them down. Right? It keeps, the more the demand for it, the deeper they go into this vortex, the deeper into lower yields, into negative, and deeper into negative interest rates they go. And the moment that people are finally done, the pension funds, the insurance companies, everybody say, okay, that's it. It's over. We can't do it no more. We are not taking on negative yielding debt. We are not going to go and buy these things anymore. We're switching to commodities. We're switching to something else. But bonds are no longer it. And the interest rates start to rise, watch out. Right? Because bonds are a very interesting investment. It's like highways going in and bottlenecks going out. Anyway, Uneducated Economist. You guys let me know. I'll leave links down in the description for you guys. Talk to you later.